Well, hello there. That battery can last up to 24 hours even with the always-on display turned on. It's pretty cool.
Welcome. Today we're going to break down the fundamentals of partnership taxation. Now this can seem like a really complex topic, but by the time we're done, you'll have a solid grasp on the core principles that really drive some of the most critical business decisions out there.
So right off the bat, we're faced with this central paradox, right? How can a business generate income but pay zero tax itself? It sounds impossible. But believe me, understanding this apparent contradiction is absolutely key. It's the very foundation of everything we're about to discuss.
All right, Section 1. So to solve that paradox, we have to start with the single most important concept in this entire area, the partnership as a conduit. So what does conduit mean? Well, the best way to think about it is like a funnel, or maybe a pipe. The partnership itself, the business entity, earns all the income, but it doesn't hold on to it for tax purposes. Instead, that income, and any losses for that matter, flows directly through to the partners. It's as if they earned it themselves. And this, you see, is a massive departure from how we treat a corporation.
And the implications of this are, well, they're profound. For one, it means you, as a partner, get taxed on your share of the income whether you actually receive that cash in your hand or not. The partnership might retain it for business needs, but you're still on the hook for the tax. But here's the flip side, and this is huge for startups. Those early-stage losses, they flow through to you too. You can use them right away to offset other income on your personal tax return, which can be a real lifeline for cash flow when you need it most.
Okay, Section 2. So now that we have the theory down, let's look at the mechanics. How does this allocation of income and losses actually work in practice? This is where the rubber really meets the road.
Take a look at this example. What's absolutely crucial to see here is how the character of each item is preserved. See that? The retail income, the capital gains, even the charitable donations, they all flow through to partner A and partner B completely unchanged. If the partnership earns a dividend, it's a dividend in the hands of the partner. If it's a capital gain for the partnership, it's a capital gain for the partner. The source and character are perfectly maintained, which has major implications for how each partner calculates their final tax bill.
Okay, now for a special rule. Things can get a little tricky when you have a corporation as a partner. You see, what happens if the corporation's year-end is, say, September 30th, but the partnership's is June 30th? Well, the government doesn't like the idea of that corporation being able to defer tax on its partnership income for months. So to prevent that, we have what's called the stub period accrual.
So how does this work? The whole idea here is to make the corporation estimate and include a reasonable amount of income for that stub period. You know, that gap between the two year ends. It's an accrual, an estimate. You take the profit from the partnership's last fiscal year, prorate it for the number of days in the stub period, and add that to the corporation's income. Then, to avoid double counting, you get to deduct the amount you accrued in the previous year. It's basically a way to keep tax payments flowing on a more current basis.
And here's a perfect example of that calculation in action. So X Limited has its year-end in September, but its partnership, Woodbar, ends in June. That creates a 92-day stub period. We take Woodbar's profit of $30,000, prorate it for those 92 days. That gives us a current year accrual of $7,561. We add that to X Limited's income, but then we subtract the $5,000 that was accrued for the prior year's stub period. The net result is the income that X Limited has to report from the partnership for tax purposes this year.
All right, moving on to Section 3. It's really important to remember that we're not just talking about the partnership's operations. The ownership stake itself, what we call the partnership interest, is its own separate asset. It's a piece of capital property, and it has its own set of tax rules, just like a share of stock.
So look at this. This shows two very different ways to bring a new partner on board, and the tax consequences are worlds apart. In alternative 1, the new partner C contributes cash directly to the partnership. See how the partnership's net worth goes up? The pie gets bigger. But in alternative 2, C buys their interest directly from the existing partners A and B. The partnership's assets don't change at all. This is a private sale between individuals, and for A and B, that could very well trigger a capital gain, a huge difference.
Now this leads to a really fundamental question of fairness. Think about it. If you're paying tax on the partnership's profits every single year as they're earned, what happens when you sell your interest? How do we stop the government from taxing you a second time on that same value, but now as a capital gain? Well, the system has a very clever mechanism to prevent exactly that. It's called the adjusted cost base, or ACB.
Here's how it works. Your ACB is basically the tax cost of your partnership interest.
It starts with what you put in, your capital contributions. Then, and this is the key part, every year your share of the partnership's income increases your ACB. Why? Because you've already paid tax on that income. Conversely, when you take money out or when the partnership has a loss, your ACB goes down. The end result is that your ACB tracks the after-tax capital you have in the business, which perfectly prevents that double taxation problem. It's a really elegant solution.
Okay, Section 4. Now let's get into a really practical and frankly, high-stakes area. How do partnerships interact with the small business deduction? This is a big deal because the SBD offers a much lower tax rate, so getting this right is crucial for any corporate partner.
So the first thing you have to understand is this. For the purposes of the SBD, the partnership is treated as a single entity. It gets one annual SBD limit, let's say it's $500,000, that it has to share among all its partners. So in this example, even though the partnership made $600,000, only the first $500,000 of that income is even eligible for the SBD rate. That limit is applied at the partnership level before anything gets allocated out.
And this table shows the knock-on effect. Look at Partner 1. It gets its share of that SBD-eligible income from the partnership, in this case, $250,000. Now, that $250,000 uses up part of Partner 1's own personal SBD limit. Since the total limit is $500,000, it means Partner 1 only has $250,000 of SBD room left for any other business income it might have. You can see how being in a partnership can directly impact a corporation's tax planning. It's a really critical point to consider.
Which brings us to our final section, and really the whole point of this discussion, making the strategic decision. How do you use all this information to choose the right structure for a business?
So whether you're starting a new venture or advising someone who is, it really boils down to these 4 fundamental questions. What's the tax hit on profits going to be each year? What can we do with those inevitable startup losses? What happens if things go south and the venture fails? And finally, how do we get capital and profits back out to the investors in the most tax-efficient way possible? You have to run the numbers for both a partnership and a corporation through this exact framework.
You know, it's easy to just default to incorporation, but as this quote highlights, the partnership is a really dynamic alternative. It's that flexibility, the ability to use losses personally, to pull capital out more easily, to avoid that second layer of corporate tax that makes it such a powerful tool. It's an option that absolutely must be on the table for consideration, no matter the size of the business.
And that really is the final question, isn't it? For any new venture, you have a choice. And given everything we've talked about, you have to ask, when does the incredible flexibility of a partnership outweigh its inherent complexity? There's no single right answer. It always depends on the specific facts, the goals of the partners, and the nature of the venture itself. Thank you for your time. I hope this has been helpful.